Everyone. Today we are focusing on solving past paper questions related to cash flows. I'll start with ISC Specimen Paper 2025. This is a sum that is related to cash flow and it usually comes for 6 marks. You'll be given two questions of cash flow. You have to choose between answering one question. So, as you already know the format, when you are making the cash flow statement, without even reading the question, this is the thing that you have to put in the page that you have and write it. Then you pick up one information and you put it in your sheet. So now what you have to write is you have to make an A section, a B section, and a C section. Where your A section says cash flow from operating activities, and in this you need to write five things. First, your net profit before tax, operating profit before working capital changes, cash generated from operations minus tax paid, you will get cash flow used or cash flow from operating activities. Then you write cash flow from investing activities and you would write your cash flow from financing activities. After that, you write net increase or decrease in cash and cash equivalent, net increase or decrease in cash and cash equivalent, and what you would get at the opening cash and cash equivalent, and you would get the closing cash and cash equivalent. These are the things that you have to keep in mind when you are doing your cash flow thing. So you write all this beforehand. Now, when you talk about net profit before tax, this will always, before tax and extraordinary items, this will always be your first working note. This you start with your balance that is there in your statement of profit and loss. Okay, closing minus opening, add the provision for tax, dividend, proposed dividend of the last year, interim dividend of the current year. You get your net profit before tax and extraordinary items. It should always be your first thing that you have to get from your working note. Okay. After you put all this, you start reading the question. When I am reading the question, Anand Limited reported a loss of 80,000. Loss is given, profit is given, loss is given, or profit is given. You go to your working note number one and you go and write this in your net profit that is that given to you as 80,000. Then you have your tax that is provided during the year. So you add the tax provision for tax for the current year before even reading. I'm telling you again and again that before even reading, we always do this. Before reading, this is always done, and it is always done. You have to do it. Provision for tax during the year, so add the provision for tax for the current year, 84,000. I'm still not finalizing the things. I will read everything and I will put it. Okay. Then you have loss on sale of plant and machinery. Now you know this is non-cash, non-operating expenses. So in your net profit before tax, what do you add is you add the expenses and you less the income. So what you're going to add is non-cash, non-operating expenses, and you're going to minus is non-cash, non-operating income. So if you have any profit or loss on sale of anything, so loss on sale, this is an expense. So I will go and write it over here. It is loss on sale of plant and machinery. How much is my loss on the sale of plant and machinery? My loss is 15,000. So I just go and write it. Okay. I go ahead. Interest on short term loans and advances. So if you have any interest on the short term loans and advances, you go and see what is this short term loans and advances. I have these short term loans and advances. That means this is my current asset. Term loans and advances, you have invested your money somewhere and you're receiving interest. Because this is your current asset, this looks like your investment. So you have invested money somewhere and you're receiving interest. So I go to the short term loans and advances. I see that before this was 11,000 and now your short term loans and advances has increased. Since your short term loans and advances has increased, that means you have invested more money over here. So it was 11,000 before. Now it has become 49,000. It means there is an outflow over here. Outflow of how much? 38,000. And on this outflow, you are receiving interest, short term loans and advances 2,000. Apart from this, I also see that this is an investment income. If this is an investment income, that means it is a non operating income. Non operating income is subtracted. So I will go and do the two effects of it. If it's non operating income, first thing, it is interest on short term loans and advances. It has to be subtracted. Another thing, this is an investing activity. So I will write over here, money is going out. It's an outflow of 38,000. And apart from this, I am going to get an interest. So outflow I will put in negative, and whatever interest I am receiving, this would be 2,000 positive. I have the two lines over here given to me. So 38,000 is an outflow and 2,000 is an inflow. Okay. Now there is depreciation on the plant and machinery. Now, whenever there is an asset, four things related to the asset will always come. If you're buying the asset, investing, selling the asset, investing, profit or loss on sale of asset, it is adjusted, and depreciation again, non-operating, non-cash expenses, it has to be adjusted. So whenever you see that information, you are going to compile that entire information and get it down. So what I will do is I will put this down and we will solve everything related to the asset together. Read this, I am going to do everything that is related to the asset over here. So I highlight everything that is related to the asset. I have a loss on sale of plant and machinery that is 15,000. Okay. Depreciation on plant and machinery is to be found out. Apart from this, I have my plant and machinery at net book value of 600,000 and 490,000. This is my provision for depreciation at 150,000 and 110,000, and I have to calculate the depreciation for the year. Apart from this, what is the thing that they have told me? Machinery whose book value was 40,000 is disposed as 25,000, and a machinery costing 2,20,000 was purchased. Okay. So all this I have to keep in mind. Now you have to choose two things. You have to prepare an asset account and you have to prepare a provision for depreciation account. But this asset is given to you at net book value. So you have to convert it into cost. Now I'm making the two accounts. One account that I'm making is my asset account at costs. Another account that I am making is I am making the provision for depreciation account. And there is a third shortcut to find out the depreciation for the current year. What you do is you write your closing provision, you write your closing at the disposal minus opening, you will get depreciation for current year. Okay. Closing what? Closing provision for depreciation, or you could say the accumulated depreciation minus the accumulated depreciation of the assets sold. You are going to get minus the opening accumulated depreciation. You are going to get the depreciation for the current year. So we start with this. I have my provision for depreciation. The closing provision for depreciation is 1,50,000. There was an asset that was disposed of. There was an asset that was sold, but I don't know about it. I have the opening provision for depreciation 110,000, and I get depreciation for the current year. So this removes my provision for depreciation account, the need to prepare the provision for depreciation account, because I prepare provision for depreciation account only and only to find out the depreciation of the current year. Now my task is that I want to find the depreciation of the assets sold. I am talking about the accumulated depreciation of the assets sold. So I see over here that my assets sold. Whenever there is assets sold, you will put this like this. Cost of the assets sold minus accumulated depreciation of assets sold gives you the net book value of the assets sold. And this, when you compare with the selling price, you get the profit or loss on assets sold. Okay. Okay. So now let's read over here. A machine whose book value was 40,000, the book value was 40,000. It was disposed for 20. It was disposed for 25,000. And I know that when I disposed it, I had a loss of how much? 15,000. Okay. So I don't know the cost of the asset that was disposed, and I do not know the accumulated depreciation of the asset disposed. So to get the cost and accumulated depreciation of the asset disposed, now I move on to my asset account, which is to be prepared at costs. So the net book value plus provision would give me the cost on the opening, and net book value plus provision would give me the cost at the closing. So cost on the opening would be 4,90,000 plus 110,000. So cost on the opening would be 600,000. Cost on the closing would be 600,000 plus 150,000. So cost on the closing would be 750,000. I'm clearly told that I have purchased an asset worth the 220,000. So my balancing figure would be the asset that I have sold. So this becomes 820,000. From 820,000, when I am going to subtract 750,000, I am getting 70,000 as the cost of my asset disposed. So 70,000 is the cost of the asset that is disposed. That means the accumulated depreciation of the asset disposed was 70,000 minus what is going to give me the net book value. So 70,000 minus 30,000 is going to give me the net book value. So this I found it as my balancing figure. So 30,000 is the accumulated depreciation of the asset that is sold. So depreciation for the current year would be 1,50,000 plus 30,000 minus 110,000. So depreciation for the current year is 70,000. This is what I was looking up at. Depreciation for the current year is 70,000. Depreciation for the current year is an non-cash expense. So this would be my working note number 2, and this is 70,000. So with this, we have completed this adjustment. We have completed this, but still, asset sold and asset purchased has to be written as investing activity. Do not forget about it. Two things you need to be very clear on whenever an asset is disposed or sold, or whenever there is anything related to fixed assets, making a fixed asset account at cost is very important. Four things definitely has to be incorporated: buying an asset, selling an asset, buying at the cost, selling at the selling price, profit or loss on sale of asset, and depreciation for the current year. Profit or loss on sale of asset and depreciation for the current year comes as a part of your operating activities. Buying and selling, investing activities. So I would go to my investing activity, and my investing activity clearly states I have purchased the non-current asset. I have purchased the non-current asset at how much? Right. Machinery costing 2,20,000 was purchased. So I have my cash flow from investing activity. I'm dealing with this part of the non-current asset. So I say I have purchased a machinery. It is an outflow of cash. So the purchase of machinery at 220,000. It is an outflow of cash. It would come in brackets. Okay. At the same time, I have also sold a plant and machinery, and this plant and machinery is disposed at 25,000, which is my selling price. So I will write it over here. Sale of plant and machinery, it is an inflow of cash, and I will write 25,000 over here. Depreciation, profit and loss. So four things related to the non-current asset is already incorporated. Depreciation is done. For tax, I have to find the tax paid. Now we are going to discuss the next part, which is this. I'm already done with the plant and machinery disposed, and this part of the plant and machinery is already completed. Now the next part that I will look at is the tax. For tax, you should know two things. Two things related to tax. It comes in your working note number 1, adjustment, where you have your net profit before tax. First thing. Second thing, tax paid would be subtracted from cash generated from operations. For this, you need to know how to prepare your provision for tax account. So I'm going back over here and I'm going to prepare my provision for tax account. So when I see this information over here, first thing, I have been given tax provided during the year. That means I've given the tax for the current year, which goes in the working note. Number one. When I read the other information over here, I don't see any tax paid or opening balance of provision for tax or closing balance of provision for tax account. Third thing, when I see over here, I am asked to prepare the net operating profit of the company before the working capital changes and cash from investing activities. That means I don't even need the financing activities. But still, before going ahead, I would want to discuss what are the things that comes in the provision for tax account. So I am discussing the things that comes in the provision for tax account. Your opening balance comes here, your closing balance comes here, your tax paid comes here, which is a part of your operating activity, is the last part of it. And the tax provided during the year, this comes in your working note number one. Now, this I am telling it comes in the working note number one. For all those who are watching my videos and my methods, you will know what I am talking about. The working note number one. Working note number one is always for calculating the profit before tax and extraordinary items, where you write your statement of profit and loss, the profit or loss that is given to you. In that, you add your provision for tax for the current year, proposed dividend for the last year, transfer to reserves, closing minus opening, interim dividend for the current year. So this all is the working note number one, and the answer for this, we start with the answer for this in our cash flow from operating activities. Since we are looking at operating profit before working capital changes, I am not looking at anything over here. Okay, let's go ahead. So I am done with the taxation part. I'm done with the first adjustment. I am done with whatever is given to me, and now I am on point number two. On point number two, I see that there are some working capital changes. What are the working capital changes? I will see over here. But I am looking at operating profit of the company before the working capital changes. That means I don't want the working capital changes also. So will I look at things over here? No, I will not look at the things over here. But if there is a working capital changes, here the current asset is increasing. So you would minus. Opening cash and bank balance goes at the end statement, which I still don't want it. Here the trade payables is increasing, so you would add. There is nothing else that is needed for you. Now what you go and you only do your closing part. So when you're doing your closing part, so your net profit before tax is 4,000. Now you're just going to go and close your statements. Your net profit before tax is 4,000. Non-cash, non-operating expenses add, and you minus this, and what you're going to get is the operating profit before working capital changes. When I put all of this on the calculator, I have 4,000 plus 15,000 plus 70,000 minus 2,000. So this gives me 87,000 operating profit before working capital changes. The second thing that we wanted is we want cash flow from investing activities. We already incorporated everything. So when I go to my cash flow from investing activities, I just need to add and subtract all of this. So I have 38,000 positive, I have 27,000 minus 38,000 minus 221,000. So I'm left with cash flow from investing activities as 231,000. Okay. So this is all that I wanted in my A part. In my first part, I wanted to calculate the net operating profit before working capital changes. I was asked to calculate the investing activity. Now they have told me taking information of credit sales into consideration. There is a credit sales into consideration. What is the credit sales? Let's say 100,000. State with reason whether increase in trade receivables. There's an increase in trade receivables of 5,000. Will cause the cash from operating activities before tax. Will cause the cash from operating activities before tax to be more or less. That means they want you to do a little bit of working capital changes of trade receivables, then the net operating profit of the company before its working capital changes. Think of what are they telling you over here is that there is an increase in your trade receivable. There is this increase in trade receivables by 5,000. Okay. And they are telling you that you take the information on credit sales into consideration. Okay. I have a credit sales of 100,000 and state with reason whether the increase in trade receivables, that means trade receivables as 2023 was 15,000. Trade receivables at the end of 2024 was 20,000. There is an increase in the trade receivables of 5,000. Since there is an increase in the trade receivable, that means less cash was collected from customers. Less cash of 5,000 was collected from the customers. Current asset is increasing, so my cash flow, okay, would decrease. Current asset works in the opposite direction. So operating profit before working capital changes was 87,000. If I put an increase in my trade receivables over here, increase in current assets, this would become negative and I would have an answer of 82,000. Now my main question over here is that take the credit sales into consideration. My net operating profit before the working capital changes is 87,000. There is a credit sales of 100,000. This credit sales will increase the profit. It will definitely increase the profit. It will increase the operating profit. However, it will not bring immediate cash as they are recorded as trade receivables in the book. So the credit sales was of 100,000. My trade receivables was 15,000 over here. My trade receivables was 15,000 over here. There was another credit sales which would increase my credit sales by 100,000, trade receivable by 100,000, but it is not going to bring immediate cash to me. So the impact of the trade receivable is that an increase in the trade receivable would represent my cash that is tied up. Okay. So credit sales is increasing and I at the end of the year my trade receivable is 20,000. That means my trade receivable is increasing by 5,000. So there would be an increase in cash by how much? I did credit sales of 100,000. Trade receivables are increasing by 5,000. That means instead of collecting 100,000, I have only collected 95,000. So there will be an increase in cash of 95,000. Okay, because out of these credit sales, 5,000 is still tied up. So they are telling us state with reason whether the increase in trade receivables in 23-24 over 22-23 will cause the cash from operating activities before tax, cash generated from operations, to be more or less than the net operating profit of the company before working capital changes. So it will cause the cash from operating activities before tax to be less by how much? It would be less by 5,000. So although my operating profit has increased by 100,000 because of credit sales, my increase in cash was only 95,000. And if I see my cash generated from operations, my cash generated from operations would be less by 5,000 because of this credit sales. So the increase in cash is only 95,000. If I am supposed to write this as my main answer, the net effect is that the cash generated from operations. So the net effect is cash generated from operations, or I would say from the operating activity, is less by how much? By 5,000. Reason is that although operating profit increased by 100,000 because of credit sales, you can write along with me, but cash collected is only 95,000, as there is an increase in trade receivables by 5,000, increase in current asset. This reduces cash inflow. So this would be your answer. And with this, I complete question number 13 of the specimen paper 2025.